Warren Buffett has spent over 70 years investing, through recessions, market crashes, wars, inflation spikes, and every type of financial crisis imaginable. In that time, he has built one of the largest personal fortunes in human history. And in his annual letters, shareholder meetings, and interviews spanning decades, he has been remarkably consistent about one thing. The mistakes that cost ordinary investors the most are not complicated. They are not hidden. They are not unique to any particular market environment. They are the same 12 errors, made over and over again by people who should know better and often do know better, but make the mistakes anyway because knowing and doing are two completely different things. Today we are going through all 12, fast, specific, and directly from the source. My name is Tomas, and this channel is about finance, automation, and building wealth through the strategies that actually work. If you are new here, welcome. Hit that like button right now and subscribe so you never miss a video. Today, we are going through the 12 mistakes every investor makes according to Warren Buffett, and exactly how to stop making them starting right now. Let's get into it. 12 mistakes. Let us move through them with the urgency each one deserves. Mistake 1. Trying to time the market. Buffett has said it repeatedly and without ambiguity. He has never met anyone who can consistently and accurately predict short-term market movements. Not once. Investors who wait for the perfect entry point spend more time out of the market than in it, and miss the recovery periods that produce the majority of long-run returns. Time in the market beats timing the market. Every single study on this reaches the same conclusion. Mistake 2. Paying too much attention to the short-term price of a stock. A stock price on any given day reflects market sentiment, not business value. Buffett thinks of a stock as a business, and he would not stop running a business he believed in simply because someone offered him a lower price for it on a Tuesday afternoon. Investors who check prices daily and react to movements are making decisions based on noise rather than signal. Mistake 3. Following the crowd instead of thinking independently. Be fearful when others are greedy, and greedy when others are fearful. This is one of Buffett's most quoted principles for a reason. The crowd is usually wrong at the extremes, buying most aggressively at market tops and selling most aggressively at market bottoms. Mistake 4. Ignoring the business behind the stock. Buffett does not buy tickers. He buys businesses. Every investment decision he has ever made starts with the same question. Is this a great business? Does it have a durable competitive advantage? Does it generate consistent earnings? Is the management honest and competent? Investors who buy stocks based on price movement, rumors, or enthusiasm without understanding the underlying business are not investing. They are speculating. Mistake 5. Overestimating the importance of short-term earnings. Quarterly earnings reports drive enormous amounts of market volatility and investor decision-making. Buffett has consistently said this is a mistake. A great business might have a bad quarter for reasons entirely unrelated to its long-term competitive position. Selling a great business because of one bad quarter, or buying a mediocre business because of one exceptional one, is allowing accounting periods to drive decisions that should be driven by business fundamentals. Mistake 6. Underestimating the power of compound interest over long periods. Buffett has called compound interest the eighth wonder of the world, and he has lived the proof of that statement more dramatically than almost any investor alive. The biggest enemy of compounding is interruption. Selling to take profits, moving to cash during downturns, trading frequently. All of these behaviors interrupt the compounding process and permanently reduce the long-term outcome in ways that are almost impossible to recover from through subsequent performance. Mistake 7. Paying high fees on investment products. Buffett has been direct about this for decades. The investment management industry extracts enormous fees that compound against the investor with the same mathematical force that returns compound for them. An actively managed fund charging 1.5% annually, underperforming the index by a similar margin after fees, costs the investor hundreds of thousands of dollars over a 30-year investing horizon. The alternative, a low-cost index fund at 0.03%, is what Buffett has consistently recommended for the majority of ordinary investors. Mistake 8. Letting emotions drive investment decisions. The investor's chief problem, and their worst enemy, is likely themselves. This is one of Buffett's most direct statements about investor psychology. The two emotions that destroy the most investor wealth are greed, which drives buying at overvalued prices during periods of excitement, and fear, which drives selling at undervalued prices during periods of panic. Building an investment process that insulates decisions from emotional states is worth more than any analytical edge. Mistake 9. Diversifying too much or too little. Buffett has said that wide diversification is only required when investors do not know what they are doing. For most investors who lack deep business analysis skills, a broadly diversified index fund is the correct instrument. But investors who do the work to genuinely understand a small number of businesses deeply can build a concentrated portfolio that outperforms through conviction rather than diversification. The mistake is getting this balance wrong in either direction, owning too many positions to understand any of them, or owning too few without the genuine knowledge to justify the concentration. Mistake 10. Borrowing money to invest in the stock market. Buffett has watched brilliant people lose everything through leverage at exactly the wrong moment. Markets can move against a leveraged position faster and further than almost any risk model predicts. A 50% market decline wipes out a 2-to-1 leveraged position entirely. The mathematical case for using margin to amplify returns in the stock market always looks compelling until the moment it becomes catastrophic, which tends to happen during exactly the kind of market dislocation that nobody fully predicted. Mistake 11. Selling great businesses too early. Our favorite holding period is forever. This is not poetry, it is the operational philosophy behind Berkshire Hathaway's most successful holdings. Coca-Cola, American Express, and Apple were not traded in and out of based on valuation metrics or market conditions. They were held because the businesses continued compounding value year after year. The tax efficiency of holding a great business versus selling and buying an equivalent one is significant. The compounding advantage of never interrupting a great business is even more significant. Mistake 12. Acting on financial media and analyst predictions. Buffett has described the financial forecasting industry as existing primarily to make astrology look respectable. Analysts who predict market direction, stock prices, and economic conditions with precision are almost uniformly wrong over any meaningful time period. Yet investors consistently modify their portfolios based on predictions that carry no genuine predictive power. Turning off the financial noise and evaluating businesses on their own merits, rather than on what commentators say the market will do next, is one of the most reliably return-improving behaviors available to any investor. 12 mistakes, all of them avoidable, all of them common. Do not try to time the market. Do not react to short-term price movements. Think independently from the crowd. Understand the business behind every stock you own. Do not let quarterly earnings drive long-term decisions. Never interrupt compounding unnecessarily. Eliminate high fees from your portfolio. Remove emotion from the investment process. Get diversification right for your actual knowledge level. Never use leverage in the stock market. Hold great businesses longer than feels comfortable, and ignore the financial media's predictions entirely. Buffett did not build the third largest fortune in history by discovering secrets nobody else knew. He built it by avoiding the mistakes almost everybody makes. The list is right here. The rest is execution. If this video gave you something worth acting on today, please hit that like button. It genuinely helps this channel grow. And if you are not subscribed yet, click that button right now so you never miss what is coming next. See you in the next one.